We, of course, are reacting to the U.S. credit rating downgrade. How significant is this when you have this second downgrade after S&P in 2011? I mean, back then, the expectation was it's just one rating agency out of three. Now you have the average rating getting lower. Does this really affect any of the investment vehicles which are rating sensitive?
I think it maybe does to a certain extent, because generally they look at more one rating agency when they're thinking about what it means for investments. I think more broadly, when you look at the market, it is a case of just still looking at the US Treasury market, its depth, its liquidity, the fact that it still represents a flight to safety if there is a risk out there. And I think the ramifications of that are likely to outweigh a lot of what you're seeing in terms of the change in the credit rating and how investors are treating it. If there was a large shock to the economy, I think you'd still see a big move down in yields as people move to the US for that safety aspect. And I think, again, that's what we saw the last time we experienced the shock. So I don't think it is as meaningful as the market at the moment, given some of the other risks that are out there.
Kerry, broadly speaking, we have seen credit spreads in various markets already tightening significantly. Do you think this accurately reflects the current macro environment?
Well, I think if you look across a range of assets, it certainly was the case that, some are thinking more about a recession than others or thinking about their prospects for growth. The tightness in the credit markets, whether it's across investment grade or high yield, has been a function that said it really wasn't thinking about a recession. These are typically non-recessionary assets. And I think as those recessionary fears start to fade away, even if they don't go away completely in the US, we can see scope for those spreads to remain relatively tight compared to what we may have seen. And given those income yields are still pretty high when we look at investment grade, the risk-adjusted return on those are actually looking pretty attractive. We think about that quality bias they hold into a portfolio. High yield, I mean, obviously you could see those spreads widen out if we get a more severe economic outcome or further downgrades to come through in terms of the high yield market. But again, they might be more muted than what we would expect to see, if there was a full-blown recession or the experiences we saw during 2008 or even during COVID.
Kerry, do you think the valuations when it comes to Asian investment grade right now are justified?
I think there's been some sort of risk applied to what we're seeing across the Asian space because of the fallout from the Chinese property sector. When we do look at how emerging markets are performing on the debt side, the focus has been towards maybe more Latin America, maybe the countries where you're actually thinking about the prospects for rate cuts to come through and that being supportive for the outlook rather than thinking about the Asian credit market in this environment. So I think there are definitely opportunities across the emerging market debt space, but I think, very selectively we consider what we're seeing. Very selectively, we consider what the impact of the direction of the US dollar will have on those assets.
Kerry, how do you feel about China at the moment? This kind of drip feed of multitudinous stimulus announcements continues. Do you have a lot of confidence in Chinese assets right now?
When it comes to the economy, I think you'll see better growth in the second half of the year. I think it's very encouraging that the noises you're hearing out of Chinese officials, even if they aren't putting, big dollar amounts or big currency amounts in terms of what they're actually going to deliver, they're very much focused on providing that stabilization to the economy. They're very much focused on reaching that 5% growth target and hopefully beating it. And so I think there is a prospect for seeing some recognition of animal spirits when it comes to the outlook for China. The risk is, though, it comes down to, how much of investors, particularly international investors, lost faith in the fact that those markets are going to move higher in this environment. We still have very attractive valuations when it comes to the Chinese market. We still think there's good long-term prospects when we think about the returns, particularly if we invest along with those policy goals around the growth in the consumer, the rising levels of GDP per capita, thinking about the safe sustainability in tech. These are all very long-run secular themes that we think can provide a good opportunity for investors in China. It might come with some volatility in the near term and the timing a little bit uncertain around that. But I think there's still a good case for thinking about assets in China. Again, I think all those actions we're hearing from Chinese officials will start to build that confidence in the market, which has been, very weak this year.